Good. So hello everyone. Thank you very much for joining us today with this webinar on the challenges and opportunity of SPACs in Latin America. We are very glad to have you here, and also thrilled to have our friends from SCADEN to join us in the webinar. Today we are glad to have with us Howard Elling from SCADEN. He's an M&A partner, and he concentrates his practice in mergers and acquisitions, securities law, general corporate matters, and he focuses on a wide variety of transactions across geographies and involving various industry groups and sectors, including these SPAC transactions, evidently. Private equity and leverage buyouts, public and private acquisitions, corporate restructurings and financing, and general corporate advice, just to say a few on his track record. We also have Christopher Barlow, who's also an M&A partner at SCADEN. Christopher focuses on mergers and acquisitions, corporate governance, private equity, SPACs, securities, and general corporate law matters. He regularly advises public and private companies, SPACs, private equity firms, and financial institutions in a variety of corporate matters, including acquisitions, divestitures, restructurings, financial advisory engagements, financing, large buyouts, shareholder activism, and takeover preparedness. And last but not least, we also have with us Jonathan Lee. He's an M&A associate with SCADEN, and he focuses on mergers and acquisitions, corporate governance, private equity, and general corporate matters. And he regularly advises private companies in a variety of US and cross-border corporate matters, including acquisition, dispositions, carve-outs, investments, financing, and evidently SPAC transactions. So without further introduction, well, on the Mijares side, we have Martin Sanchez and Ignacio Armida, who are also partners at the M&A practice and the corporate finance in general. And so without further introduction, I will leave the floor to our friends at the SCADEN to take us in depth in the SPAC world.
Wonderful. Thank you. Thank you all very much. Thanks for everybody joining today, and our thanks to our dear friends at Juarez for organizing this and inviting us to participate in this discussion. We thought we would start with a little bit of the state of the market in SPAC world. And we put up a couple of slides, which I hope everybody can see. I just want to make a couple of observations about them. So we focused on, a relatively short period of the last couple of years, where you can see first dramatic growth, right, in the SPAC IPO market, and then a dramatic drop-off in the SPAC IPO market. But for everybody to realize, the SPAC is not a new product. These have been around, for 30 years probably. There have been prior SPAC boom and busts, but there was nothing quite like last year in terms of the SPAC market. So what you saw last year was that SPAC IPOs were bigger than regular way IPOs, right? That the numbers just kept accelerating as the year went on, right? That they covered every type of industry and covered every type of space around the world. And you had really a sort of robust marketplace with billions of dollars of capital being committed into these vehicles. And the charts you see here are actual SPAC registration and listings, not just filings, which there are a whole bunch more in that category as well. In trying to track them, I think for this group, it's interesting to note, that we found, 6 LATAM SPACs that are floating around out there, and 2 recent ones at the end of 2021, and 1 in 2022. When we look at what happened, right, after shooting up and having a massive increase, right, what you've seen in the last few months is a massive decline in the new number of SPACs that have successfully gotten to market, and a very significant abandonment of registration statements of people trying to do a SPAC and then not even getting to the public marketplace. So, you get 28 of those that were withdrawn, in the last 2 months. And our friends at the SEC, which we'll talk about a bunch during the course of this presentation, have declared a number of them abandoned because they were filed, waiting, and not gone actually public for too long a period of time. So if we can flip to the next slide. There we go. So this is the other side.
Sorry for to jump in.
Yes, please.
You were mentioning that SPACs are now providing for friendlier terms, SPACs IPOs, and these I believe include shorter timeframe for completing the business combination. What do you believe these shorter terms, or do you believe these short terms are reasonable in the context of business combinations with a potential LATAM targets?
So I think that the life of the SPAC, which is one of the things that investors have pushed back on. So the historical SPAC lifespan was 24 months. There have been a number of deals done very recently that are now, 15 months, 18 months, shorter time periods. I think those SPACs are definitely going to be under pressure to get deals done. But I think what all of the companies and all the participants need to keep in mind is that a brand new SPAC with 15 months of lifespan, right, may not be that much at a competitive disadvantage compared to a pre-existing SPAC that was done last fall, for example, right, and is already down to 18 months. I'm not sure that we'll be able to really say that 15 versus 18 months makes a big difference. But I think underlying this point is the need for the companies to really realize that you do have a limited time in terms of the lifespan of the SPAC to get a deal done. There is an ability to extend, which we'll talk about later, but I wouldn't rely on that. And the companies need to, and their advisors need to make sure that the company is actually going to be ready to be a U.S. reporting company, right, in the period of time that you have available. And that's really the hard work.
Thank you.
Maybe we can flip forward to the de-SPAC state of the market. And here, once again, you can see an incredible uptick in the volume, right, of transactions, right, that were occurring, followed by a decline, and a significant decline in deal-making activity. Last year was a record-breaking year for SPAC, de-SPAC transactions. Nobody had ever seen anything quite like it, but an awful lot of those were front-loaded in the first half of the year. By the second half of the year, you start to see volumes declining, by 30%, and into this year, by 77% compared to prior periods. So that's a significant drop, but nonetheless, right, there are continuing deals that are getting done. And the question, I think, longer term in the SPAC market is, once we go through the boom and bust cycle, when do things sort of reach normalization? And what does a normalized SPAC market look like in the future? I think it's too soon to know when that is. But I think, we are generally of the view that, subject to rulemaking that the SEC might do, which again, we'll talk about a bit later, the de-SPAC is a tool that should remain viable and should be of interest to plenty of companies to consider as they think about whether they want a regular way IPO, direct listing, de-SPAC, a sale. One of the other things we want to note which is really sort of new, is that signed up de-SPAC transactions, we've seen a significant number of those deals terminate. Historically, there were virtually no terminations once the de-SPAC transaction was signed, right? The first quarter of this year, there have been 15 already. It's a tremendous number. And it's a sign that again, confidence right now in this market is uncertain. And one of the interesting aspects of these transactions, which folks should consider, is that we are seeing the target companies pay the SPAC a breakup fee in order to get out of the deal. These are not breakup fees that were negotiated at the time that the de-SPAC was signed, although there are a few of those, but these are often deals that otherwise could close, but the target company has concluded that they don't want to, that the marketplace is not where they want to be at this point. We can move forward to the next slide. So in terms of where we are, however, and opportunity-wise, at least by our last count, there are over 600 SPACs that remain publicly traded in the marketplace. They've got $187 billion of capital invested in them. So there are opportunities here, and lots of them. All of these companies are going to continue to try to find transactions. Performance has been iffy. You can see some stats as we go down the page. Share prices pending a transaction are trading below the $10 IPO price. Once you close your de-SPAC, they're trading further below the $10 de-SPAC. But Latin America has outperformed the SPAC market generally in terms of where those stocks are trading, even though I think 4% is not great. Down from the $10 price is a lot better than 29%. One of the things that has also happened in the marketplace is that pipes are becoming increasingly difficult to obtain. Pipe used to be sort of a basic structuring item in a de-SPAC deal. It was a way that you brought in longer-term investors, both to stay in the stock and to validate the price that the company.
Howard, sorry, Howard, and this is something that we would like to learn a little bit more about. Yes. Because earlier, I mean, if you couldn't get the pipe investors set up, that mean that you really couldn't have a deal done. But now, as you're mentioning here, we're seeing a large percentage of these SPACs that have don't have pipes, no, even though the majority of them still do. So, is there a real chance for success to do a SPAC deal when you don't have a pipe lined up?
You know, I think the answer is we're going to have to see, as these deals are still, you know, kind of in the sign and SEC registration process and have not gotten to their redemption and voting dates. It will depend a lot on how the redemption goes, what the target company wants in terms of capital raising, and whether or not between the signing and closing, this lack of a pipe can be backfilled either through alternative financing arrangements, pipe actually coming in, or non-redemption structures with the shareholders of the SPAC. So if you think about a mid-2021 SPAC deal, you know, you might have 250 million, right, in the SPAC, 500 million in the pipe, right, and you're hoping to get, you know, 750 million total, right? Now, did you need the 750? Depends on the deal. If you have no pipe, now you're targeting 250 million. So is 250 million adequate for what the company needs? And what's your risk profile on redemptions? Now, the current redemption market has not been good, as we've seen those numbers ratcheting up. and at least in February, which is a short, limited universe of transactions, the average redemption rate was 89%. So if you have no pipe and an 89% redemption rate, you're not really raising any capital. And so I think those deals are highly at risk unless some type of alternative financing shows up between the signing and the closing.
Yeah, that makes a lot of sense. Thank you.
And Howard, another question related to to ensuring the success of the deal. We do know that in SPACs there are requirements to make representations that the targets or specific targets have not been identified or have not been approached. But what are the specific restrictions of what can be done before the SPAC is launched in terms of identifying targets or approaching targets? What are the type of reps that need to be included, and if any approach has been made, what are the disclosure requirements? And finally, what are the implications of breaching those reps with respect to not identifying or having a minimum approach with a target? And I'm mentioning this because in the LATAM world, the sponsors that make a SPAC or are attempting to launch a SPAC in the US need to be aware of this, because probably there are not precedents, at least here in Mexico, and these are things that have a particular relevance and implication in terms of misrepresentation and so far. No?
Sure. So the short answer is, for the sponsor, right, they can sort of sit around and do whatever they want in terms of thinking about ideas, right, knowing how they might go about approaching somebody, knowing why they might want to do a transaction prior to the time that they've actually gone public. But in terms of approaching anybody or active engagement, that is of incredibly high risk and really should not be done. The sponsor and the SPAC are going to make a representation to the underwriter, to the SEC, and are going to make public disclosure that they have not done that, right? If they were to have done it and not made disclosure, you would have a basic, US 10b-5 claim, right, for fraud, right? Because the only purpose of the SPAC is to find a deal. And if you've got something going on and you haven't made disclosure, right, you are putting yourself at tremendous risk, for a basic, securities law claim here in the United States and an SEC enforcement action. What might occur from a damage perspective is unknown, as nobody's actually done that, or at least been caught doing it. There are a few rumors, but nobody's been caught. From an SEC enforcement perspective, they may shut down your deal, right? They may stop you from proceeding so that, you as the target company are going to be left hanging. They also may come after the sponsor and, basically bar them from further activity in the SPAC space. So these are all very problematic outcomes. In terms of what you can do about it, not much is the answer, because you're never going to have enough available information at the time of the IPO to describe the target company who you're engaged with. It's really not going to be possible, right, to do that. So, I would say, simply don't do it. Figure out amongst yourselves who you might look at, how you might go about it, what you think you're capable of, but approaches, feeling people out, right, trying to start the work is really a very poor idea prior to completion of your SPAC IPO.
Thank you.
Thank you, Howard.
Okay, great.
Please
Well,
go
with that, I think we'll turn it over to Chris.
Thanks, Howard, and great to be here, just echoing what Howard said. I will talk about some of the both structuring trends that fall out of some of the market update that Howard referenced, as well as touch on some of the regulatory and litigation trends that we're seeing in SPAC transactions. I'll sort of preface it at the outset. You saw with the data that Howard presented, it has been an extraordinary, sort of rise and to some extent, decline in activity. And we always sort of like to joke among SPAC practitioners that SPAC timeframe is like dog years, meaning that 1 month is like 7 or 8 months. Things really change quickly. So a lot of the things that would have been true, as Howard was saying around pipes in a 2021 mid-year SPAC transaction. A lot of that has changed, and we expect a lot of this to continue to change, particularly given the opportunities that Howard referenced. When you have 600 plus SPACs out there, these things are built to do a deal. We certainly find ourselves in a challenging market, but people are going to think creatively, and people are thinking creatively to try to figure out some of the challenges that we're sort of all facing. And it really is a day by day type thing. So a lot of what you'll see on here, I think the big takeaway is to realize that a lot of these mechanisms, people are still continuing to think about where they can push and try to find something that's ultimately going to work well in this market. So it's sort of a little bit of a stay tuned and keep your eye on all of these things. But what you see here are the promote, the pipe, and redemption. I think there's a lot of focus on how these levers, can be used to help, solve some of the issues that we're seeing in the current market. The promote is I'm sure everyone, on this webinar is aware, is really what the SPAC sponsor, gets. Not as compensation in a tax sense, but as for setting up the SPAC enterprise and going out to source the deal and ultimately execute on it. It's typically 20% of the SPAC IPO that the sponsor gets. That's built into the IPO structure. But there's a lot of flexibility around that. And that flexibility can manifest itself both at the time of the IPO with the sponsor, either giving some of that promote potentially to anchor investors, or at the time of the de-SPAC, so that even if the IPO was set up to give the SPAC sponsor that 20%, that can be very much subject to negotiation. It is by far, written in stone. And we've seen a lot of people use those economics as ways to solve various value issues, or attempt to solve is maybe better put. And sometimes that can be done between the SPAC sponsor and the target, and sometimes that can be done between the SPAC sponsor and the pipe investors, or the SPAC public shareholders. Really, that promote can be used in a variety of ways, and you can see them listed here. Sometimes that can be a straight forfeiture. So rather than getting the 20%, the SPAC sponsor just agrees to forego some of that to make the resulting dilution less. Sometimes we do see a forfeiture mechanism tied to a backstop of redemption, so that if redemptions go above a certain level, the SPAC sponsor will forfeit some of its economics on the theory that the resulting transaction is resulting in less capital than people were hoping for at the time that they signed it up. In this really high redemption environment, doing a forfeiture mechanism can really be quite meaningful from a SPAC sponsor perspective, meaning that they can end up as a result of this forfeiting quite an amount of their promote. Sometimes sponsors do agree to put some of their promote as is almost like a bonus pool or consideration to try to incentivize public SPAC shareholders not to redeem at the time that they can exercise that redemption right. Sort of the idea being that if you stay in the stock and don't redeem, in addition to getting your share in the warrant that the SPAC shareholders get in the IPO, they also do get a portion of the sponsor economics, and that's supposed to help incentivize them, incentivize the shareholders, not to redeem. This has been talked about. It's been, put in place in a couple of deals. I think, Howard, keep me honest here. I think the one example where it's sort of gone through, it has not been successful. It was still very, very high redemptions, that resulted. But Howard, any other color you want to add in, please do.
Yeah, that's right. It was on a transaction involving a company called Starry. They had attempted to create an incentive structure whereby non-redeeming shareholders would get their pro rata share of a pool of additional shares. They priced that at about 20 cents a share. So it wasn't a lot, right? It was pretty minimal, and it didn't really work. So there's a second one in the marketplace that's priced at 80 cents a share. That'll be a few months before we see the results of that, and people will gauge whether, a 4x increase is enough, or if you want to try this structure, you're going to need to even offer more to the shareholders.
Thanks, Howard. And then just to round out on the promote, often we will see SPAC sponsors subject some or all of their promote to an earnout structure. So really to try to tie the earning of that promote to some real or perceived value creation represented in the form of a stock price. So you may see, X percentage of the sponsor's promote vesting at, $12.50, and then another tranche vesting at $15. So that when a, de-SPAC is successful, the SPAC sponsor ends up earning its promote. Moving to the PIPE alternatives, as Howard referenced, in his market update, certainly the PIPE market, has been something that has been challenging for de-SPAC transactions. If you think back to a year ago, and especially in the first quarter of 2021, it was really almost unlimited demand on the PIPE side. So a lot of times we saw companies who may have been considering, a regular way IPO quickly pivot to a SPAC transaction, realizing that between the trust that a SPAC brings, which is subject to redemption, though at that point, redemption levels was much lower than we're seeing currently, and there was a real ability to upsize the PIPE. So a lot of times, when you compared a de-SPAC transaction in that environment to a regular way IPO, there was really a multiple, of capital that could be raised on the de-SPAC side, which made that, more attractive. You flash forward to today, right? There was such a, really, robust PIPE market that I think a lot of, potential, investors got, overextended, as Howard had referenced, a lot of the, the performance of newly de-SPAC companies, has been, less than I think what people were hoping for, though I will say as an aside, it's, not necessarily unique to a de-SPAC company. I think, that observation could fairly be made around a lot of the regular way IPO companies as well. But, a question or discussion for another presentation. But, that's all resulted in the PIPE markets today being extremely challenging. And as was previously discussed, we're seeing some transactions, sort of go to market without a PIPE. As Howard referenced, those are, exceptionally risky transactions. And then the ones that are coming for a PIPE, it's taking quite a bit longer to get a PIPE in place before a transaction is announced. I mean, we used to see transactions, that could be in, the 3 to 4 week time frame, even in some cases sooner, from when they started the PIPE marketing effort until they announced a transaction with binding PIPE commitments. It is certainly taking significantly longer than that in most contexts now. And people have to be very, very strategic about how they're going to build that PIPE. So, sort of friends and family, to use that term loosely, does the sponsor, are they willing to make a commitment? If they're a private equity fund who set up a SPAC, do they have, are they willing to bring money? Are they willing to backstop a PIPE? Are existing strategic investors in the targets willing to double down and, put more money into the pipe. Things like this are really the indicia of a strong pipe raise in this market, especially if you're going to be trying to do anything, regular way. You really need to have, people who have money in it, know the asset, willing to put up more, the SPAC sponsor who's bringing the company willing to sort of put in. And then we're seeing sort of a lot of structured products and certainly a lot of discussion around it, as people are exploring de-SPAC transactions. So things like, convertibles, adding warrant features, as I referenced, using the sponsor promote, to sort of make it more attractive when you compare it to a straight common product. We're definitely seeing a lot of conversations around structure. There's always sort of a real value, evaluation that the target needs to go through when it's looking at these sort of structured products, because on the one hand, you have the dilution from the SPAC sponsor, promote, and, all the fees associated with going public. And then, often these sort of structured pipe products are more expensive. So, a lot of times we're seeing SPACs or SPAC targets, really have to think long and hard about whether they want to sort of go down this path. But it's certainly something that's very frequently discussed in these transactions in this market. And then we're looking at other things, just sort of, a straight lower valuation of the target than, what they may otherwise, be hoping for, on the theory that will make, pipe investment, more attractive, as they can share in the upside. Sometimes even just pricing, the pipe at less than $10, that does have an effect on the warrant, which can further, increase dilution if it's priced too low. And then, other things just about, sort of open market, allocations and purchases and, facilities and things like that various participants are looking at. And, there's a lot of SEC rules that need to be thought of.
Sorry, Chris.
Yes, please.
Yeah. Sorry, Chris. I wanna pause a little bit on an item that you just mentioned, and that is that some alternatives to a pipe investment is being found by evaluating the common shares at less than $10, which, as you mentioned, obviously has a dilution effect that adversely affects the shareholders of the target company, no? And this is obviously also a concern with regards to LATAM targets, because of the way that the LATAM targets are typically owned here in these jurisdictions. So do you think that this is a realistic alternative for a LATAM SPAC deal, or have you seen it that it presents additional challenges for completing a successful deal?
Look, it is certainly something more often discussed than done. I think it has been done a very limited number of times, and it does pose some of the challenges that you reference. In addition to other challenges, it does, if the shares are priced too low, potentially increase the dilution of the transaction by triggering dilution adjustment mechanisms under the SPAC warrants. So it makes that dilution more acute. It also sends a bit of a weird signal, right, in that the deal is priced at $10. The SPAC shareholders have the ability to, redeem their shares at $10 plus, the minimal interest in the trust account. And it's you're essentially asking, the SPAC shareholders to stay in at, $10 and not redeem, while you're simultaneously selling, to the pipe at less than that. So it definitely poses a lot of challenges, no doubt about it. But it is something that is on the table, right, as people are thinking about, how to solve some of these problems. And as you can sort of see when you look at these buckets around the promote, the pipe, and the redemption, right, a lot of them are really, really intertwined, right, such that if you pull on one lever on, the pipe side, that may have an exacerbating effect on the redemption side, for instance. So it's not sort of an easy, puzzle to solve for, from that perspective. So, but you're 100% right that it is something that I think people have concerns overdoing for all of these reasons, and that's why it's sort of rarely done, but it is something that is considered, right, as part of the options. And then just finally on the redemption here, is Howard noted, we have a fairly limited sample set, this year. We're both early, in the year, and the amount of transactions closing, relatively speaking, is somewhat less. But it is certainly a high redemption environment, and I think if you look at it, compared to a year ago in Q1, it was much lower, and it's sort of been on a steady uptick of redemptions, where I think now we're at around the 90%, which essentially means, right, what is in the SPAC trust from its IPO, the vast majority of that capital is at risk, where that, it's always at risk from, sort of a legal perspective, but from a market perspective, a year ago, it was much more theoretical, but, with some of the shifting market dynamics, it's become a very, very real risk. And there's been sort of a lot of negotiation around this, both in the deal terms around the minimum cash condition, and just from a business perspective, having the target have to very seriously think about what is the minimum amount of capital and the cost of that capital, that such that at the end of this thing, we as a target company are going to be willing to do this deal. So quite often we'll see the minimum cash conditions set around the pipe, right? Essentially what that says is the target company is willing to go forward and do this transaction just with the pipe money, and anything that's in the trust is really upside. Obviously, everyone hopes that they can get it, and they'll put in some of these mechanisms that you see here to try to make that happen. But so far, sort of no one's really been able to fully, solve that puzzle, right? We've seen, these earnout pools, like we were saying. We've seen people, explore, a bunch of other things, try to get non-redemption agreements, from their shareholders, try to, subject part of the promote, as a backstop, things of the like. But, really none of it has truly moved the needle. There's been some sort of relatively expensive, products from hedge funds that are offered that covers, somewhat small but meaningful amount of the shares in trust, but it is still very expensive. So I think people are still trying to figure it out. Part of this just may be overall, market appetite for, if you think of like the kind of company that has historically been, the target of a de-SPAC transaction. It's been high growth, often tech companies, although it really has spanned, the range of industries. Some of these companies in sort of the current, environment from a macroeconomic perspective, rising interest rates, inflation, things of the like, may just be, less attractive investments. So it will be interesting to sort of see, how the market adjusts from the SPAC side in terms of, targets that they're looking to potentially, bring to market. So we'll see, but these are definitely things that are all actively considered, and there are really new ideas, daily that, we are considering, along with friends.
And Chris, just elaborating on these structuring trends. I mean, throughout these past 2 years, we saw a bunch of SPACs sponsored by, at some instances, sponsor teams that have no necessarily track record, or a robust track record, or no track record at all. And this led to having a lot of SPACs IPO or SPACs in the works, with some of them, per performances. Is it fair to say that the market is, accommodating itself to favor or towards, favoring SPAC sponsor teams that have very good track record, which at the same time would not require all this creativeness around the structuring of the SPAC IPO, and with good track records, perhaps it would be easier to secure a pipe. At the same time, it would provide more, confidence to potential targets And at the end, it would be as it was in the past, no? Be like a big boy, a good track record, investment vehicle, or what are your thoughts around that?
Yeah, it's a great question, and it's sort of interesting because, as Howard referenced at the outset of the transaction, right? The SPAC product is not new; it's been around for a long time. But I would say prior to the current, iteration of this SPAC, boom and cycle that we're going through, it was one of these things that was sort of relegated in the corner of the capital markets and was not sort of very mainstream. I think for a host of reasons, you had really quality people looking at this product as a potential new way to take a company public. And so I think when you sort of take a step back and look, right, we have definitely had a really meaningful uptick in smart and quality institutions and people sponsoring SPACs as a general matter, right? But because the market was so hot, you certainly really got anyone who potentially had interest in doing a deal like this come in. And I think it's one of these things that people often debate, and I think it goes back to what Howard was saying is, once, you sort of had such a crazy market, called a year ago and through much of last year, there's clearly, some, correction going on in that. And then you ask the question, well, what is sort of a more normalized steady state SPAC market look like? And, it is certainly something people talk about. Is it going to be the kind of thing that's institutionalized with more successful SPAC sponsors who do have a better track record, and there probably will be, sort of winners and losers, but it is certainly one of those things that it is being actively discussed. I will say, to your specific point, in this environment, I think even some of the highest quality SPAC sponsors are still finding it very challenging. I still don't think it's an easy pipe race for them. Even though they have a good track record, it is certainly helpful, and I think will be helpful in the long run, given the specific market dynamics that we find ourselves in. It is still incredibly challenging. I don't know, Howard, if there's anything you wanted to weigh in on that particular point.
Yeah, I guess I would just say it would be sort of nice if it were that sort of simple and binary, so you could draw a direct line. Reputation, background, success, right, means pipe, means less redemptions, means successful de-SPAC. It kind of isn't quite working that way at the moment. So we've seen in the multi-plan case, for example, which is the big piece of litigation, right, in the US, and a very unsuccessful deal, that was done by one of the lead SPAC sponsors, right? And that one did not work out well. At the same time, Shaquille O'Neal had his deal done, and that's done pretty well, right, and was quite successful. So it just is an interesting, sort of, I think Chris has captured it right. The state of the marketplace is not yet settled enough for us to be able to say that, these factors lead to a better deal. But I would say to any company looking at this, very carefully choose your partner. Make sure they're people you want to work with. Make sure you're people you want to be in business with. Make sure you have the confidence that, they can raise money, right, to put a deal together.
Yep. And then just two other things just to touch on from a trends perspective. Howard referenced one is, litigation. These are public company transactions, and as is probably familiar to folks in this audience, public company transactions in the United States are subject to litigation, and these SPAC deals, have certainly been no exception. A lot of it is in sort of the, call it more, nuisance, and I use that in quote, litigation where it can be fixed with, some corrective disclosure and payment of the plaintiff's fees, and they go away. But we have found, some real litigation, on the multi-plan, case, as Howard referenced, coming out of Delaware, and there have been a couple of other cases as well, of note. So it's certainly something, that we are keeping an eye on. There was sort of an academic debate around in Delaware, which is are SPACs, fundamentally, different in some way, and should they be analyzed, in some different way than, sort of a traditional U.S. public company? And, by and large, the answer to that is no. Really, the traditional, rules around fiduciary duties, conflicts of interest, and the like apply. And, that's, sort of consistent with how we've been advising clients in any case, but it was an open question, and at least appears to have there's been a shot fired by the Delaware Court of Chancery on that. But look, these things are going to be subject to scrutiny, from the plaintiffs' bar here in the United States. And then I think that the second thing is on the regulatory front, the most significant of which is the SEC. The folks in charge of the SEC under the new administration certainly have a strong point of view on these SPAC transactions. Just given the significance and the level of activity, and that all crosses through across the SEC's desk. It is something that they are taking a look at. We expect them to come out with rulemaking this year. Exactly what that is, what that's going to look like, is certainly subject to a lot of speculation and debate. We've heard, the higher ups at the SEC focus on things like the ability to, use projections and rely on the safe harbor. The lack of, an underwriter liability when compared to, a traditional IPO. These are things that have been, discussed, and would not surprise us if the SEC comes out with rulemaking, to address certain things in these areas, whether real or perceived, but we don't know, right? And we'll find out. But that is the most, I think, significant thing that we're keeping an eye on from a regulatory perspective. There's been a couple of bills floating around, the U.S. Congress, around SPACs and really around similar things around the promote and use of projections, but we don't really think those have a high likelihood of getting through, just especially given our climate that we find ourselves in politically in the U.S. So it's really going to sort of be what the SEC does, and then on the litigation front, what the courts continue to do. So I just put those out there because those are two just other less structuring trends, but definitely trends that we as practitioners are keeping an eye on. Next slide, please. So this, we just laid out, I think Howard referenced the handful of Latin American de-SPACs. I think, from a performance perspective, these have actually, I think traded, quite well. So, limited sample set, but, maybe some room for opportunity, in the region, given the number of SPACs. Broadly speaking, there's only 5 of them, but, in sort of the industries that we're seeing, outside of Latin America. And so, what will really be interesting to see if some of the SPACs really focus on Latin America as a potential geography to identify companies and take them to market. And we know there was, I think, one, within the last week or so, out of Brazil, focused on a Brazilian company. So, will definitely be something to keep the eye on. And, we think there's a potential opportunity there, especially, like I said, limited sample set, but appear to be trading well. Next slide. Okay, now we'll turn it over to our colleague, John Lee. He will just very quickly kind of do a compare and contrast of, what characteristics in a U.S. company versus a Latin American target need to be present in order for there to be a successful de-SPAC transaction.
Thanks, Chris. Yep, like Chris said, I'll be discussing a few key considerations, focusing on the differences. So we'll probably just touch upon a few of these on this slide and the next one. So the first consideration is PCAOB audited financials. They're required for the S4, and the placement agents are lately requiring them as part of the PIPE process. So depending on the structure, whether the target qualifies as an emerging growth company or a smaller reporting company, and whether the SPAC is filed at 10K, the target typically needs 2 or 3 years of these financials. So as Howard noted previously, the timing for the SPACs to find a deal has decreased recently. And if a private company target hasn't prepared PCOB financials, that may impact what targets are viable for the SPACs, just for timing and the timeline for the deal. So one of the first questions we always ask is, are the PCOB financials ready, and what their auditors say the timeline will be if they're not. So another related topic is the public company readiness of the target. This includes whether the target has internal and disclosure controls, good books and records, good governance practices, meets listing standards and compliance with any local rules. Sometimes targets are only a few years old without management or a board with public company experience. So these matters sometimes need a substantial work in order to be ready by the time of closing. This includes finding public company ready officers and directors. So the earlier the target has these matters ready, the smoother the process typically. So the next big topic here, I think, transaction structure. So one of the big issues we face in the beginning of a process is always structure. Although we're not tax lawyers on this webinar, but I can provide what we typically see with targets outside of the US. So the transaction structure is typically more complex with the non-US target, and it highly depends on local and target tax considerations. This depends on not only the jurisdiction of the target, but also where its income and likely income will be. Generally, it's difficult for US incorporated SPACs to cross borders and pursue a non-US target due to US inversion rules. These are the tax rules relating to US companies trying to migrate out of the US. But most US listed SPACs are not US incorporated companies. They're mostly Cayman and some BVIs. So this practically isn't going to be an issue, but just something to keep in mind in case there is a US SPAC that's part of the deal. So 3 typical structures we do see in this context is the SPAC as the acquirer, or the SPAC as the target, or the formation of a new holding company or a public company. So if the SPAC is the acquirer, there are usually no US tax issues. It's pretty straightforward. This is what we typically see with US targets, but local tax implications also need to be analyzed. So if there are no local tax issues, then the structure is typically just a reverse subsidiary merger, which means just the SPAC creates a merger and the target merges with that entity and survives. So in the second scenario, if the target shareholders need to stand still due to local or tax or regulatory reasons and the SPAC needs to be the target, you may have potential US tax implications. In the third scenario, if a new public company is created, such as in a double dummy structure, sequencing matters. So the SPAC goes first into the new public company, and the transaction can be treated as tax-free, a tax-free reorg. If the target goes first into the new public company, then the transaction will be treated as what we call a 351 transaction. So the SPAC warrants may be taxable. This is typically more of an issue for the sponsor, given the basis of their warrants. Additionally, in addition to tax, there's also local regulatory considerations that shape structure. So there's regulatory bodies like CFIUS in the US and similar bodies in other countries that may have restrictions on where shareholders sit. So that's something to keep in mind. So I know we're running out of time a little bit, so I think the next slide. Just wanted to touch on the foreign private issuer point. So a lot of times with non-US targets, you have a combined company that will be a foreign private issuer if the company is incorporated in another country. So the exception to this is if the company meets certain criteria to exclude it from FPI status. So the test is that if more than 50% of the target companies held by, or the combined companies held by US holders, and a majority of the directors and officers are US citizens, 50% of the assets are in the US, or the business is principally administered in the US, then the issuer is going to be domestic rather than FPI. So we analyzed the cap table and the business pretty fairly on to determine whether the combined company will be an FPI or not. So once we know the issuer is going to be an FPI, there are certainly some benefits to being one, usually in the form of relief to certain disclosure or filing requirements. So just to give a few examples, there's no quarterly reporting like 10Qs. They're not subject to accelerated filing for their annual filing. So I think they have around 4 months after year end. They're exempt from US proxy rules. They're exempt from insider trading reports. This is forms 3, Form 5. They're exempt from Reg FD and Reg G. Those are the regulations that prohibit selective disclosure of MNPI, material non-public information, and the regulations that deal with non-GAAP measures. But typically FPIs continue to follow these rules just as a matter of best practice. There's also limited executive compensation disclosure, which is a big one. And this includes, the F4, and they're also, as discussed before, they have the ability to use, US GAAP, IFRS, or local GAAP. And they're also exempt from certain NASDAQ or NYSE governance requirements, except the audit committee typically has to still be independent. So I think the last point that we would touch upon here is just antitrust is typically not a concern, but it all has to be considered and analyzed. On the US side, HSR filing is most commonly required, but you need to look into it for anything in non-US jurisdictions as well. There's also other regulatory considerations like CFIUS and other national security type issues. So I know we're running out of time here, so I think that we can stop there. The next slide is just some general observations.
Thank you very much, John. Thank you very much to all. I think we have a few minutes left, and we wanted to make some of the questions that we have been receiving from the audience. We have received plenty of questions. We believe that the majority of them have been responded throughout the presentation, but there are a couple that we may want to expend the last minutes. One of the questions refers to what we were mentioning earlier in the presentation regarding the termination fee, and it is what happens when a target pays a termination fee? If the SPAC has no time to close the business combination, is it liquidated or extended, or does the sponsor get the termination fee to cover risk capital?
So I'll try to answer it. It's a very good emerging question. The idea of a breakup fee in a de-SPAC transaction remains relatively novel. There are now a few, and people are sort of debating these components. There's going to be a few factors that come into play to start with. First is, are you Cayman or Delaware as a SPAC? Second, what do your constituent documents say? Right, have to be reviewed. From the SPAC perspective, if your deal busts and you get a fee, depends where you are in your lifespan. So you're not freed from pursuing a future deal. You're still supposed to try to get a deal. So that needs to occur, and you need to still try to get some other transaction done. Now, if you don't get a transaction done, then you may reach liquidation. And then there is a great debate over, once you pay out the liquidation to your trust shareholders, are they entitled to participate in this breakup fee? Now, obviously, you've got to pay expenses. You've got to deal with your debtor creditor issues in a liquidation. But if there is excess left, there is a debate that is going on as to whether or not that can appropriately be given to the sponsor, or whether, because of the constituent documents or Delaware or Cayman law on the duties that directors have to their shareholders, whether it needs to go to all shareholders. And again, I think it's going to end up being somewhat deal specific and somewhat a question of risk tolerance. As folks discovered in the multi-plan case, a lot of the directors end up holding shares that are the same as the sponsor shares, and they don't hold shares that are the same as the public shares. So if the breakup fee is distributed to all directors in part, right? How will the court look at their breach of fiduciary duties, given that that is now a related party transaction? Based upon the multi-plan case in Delaware, it would appear to be not favorably. So a lot of issues there that have to be worked through.
Okay. So finally, an additional quick question that we have from the audience is, can SPACs pivot their investment strategy after the IPO?
Short answer there is yes, in that they have. So there are a lot of, we try to write a lot of our IPO documents so that the types of transactions that the SPAC could do are pretty broad. We try not to get them too limited at the outset, but there are certainly some that do describe themselves as they're only interested in X type of thing. They then do something that doesn't seem to be X. No one yet has been successfully sued or really even pursued with respect to that issue. And the SEC to date has not raised any issues on that front.
Okay. Thank you.
So thank you very much. Thank you very much, John, Howard, Chris. It was very, very good to have you here. We have left out certain topics. We realized that it was kind of ambitious, but perhaps there's still, material for a second round of questions or a follow-up webinar. And we want to thank also our friends that joined us during the session. Thank you very much. This has been, recorded. If someone wants to have the video, just send us an email, and we can, certainly forward that to those. And if anyone has any follow-up questions, either for our SCADEN friends or for us, happy to receive them via email, and we will try to reply expeditiously. Thank you very much again, and have a good morning.
Thank you so much.
Thank you all.
It's been a pleasure.
Thanks all.